What you have here is an expectations correction, just like you had with Alphabet. Look, they missed numbers. You missed numbers, at least on the top line. The stocks are going to correct. The question is there a fundamental correction going on in these two names or not? And Alphabet, I think emphatically there is not. That advertising revenue growth, which is really the bread and butter of Google, and it always has been, is still growing 21% year over year. It's the exact same growth rate as the last 7 quarters. Amazon did give you a slowdown in international markets, but I think there's some pretty thoughtful explanatory reasons for that. Comps were much tougher. They had this acquisition of this Middle Eastern e-commerce company called Souk, and then they had this Diwali national holiday timing in India. If you look through that, I think the growth rates are very consistent, and you had these record high operating margins. I think that Amazon remains a top line organic 20% grower, 30% gross profit grower with expanding operating margins. So I think the thesis is there. We're just having a reversion in the stock price back to the median forward multiple. No, it's not a back up the truck price here, but we still think you'd wade in and buy the shares on this kind of correction.
Colin, your take on the guidance for Q4 with Amazon. It seems to me that shipping is potentially one of the biggest sort of up in the air, questionable factors for the quarter, especially when you have the company coming out and saying that they're not sure whether they're going to have too much capacity or not enough, and what fuel is going to do as they see this surge of holiday package deliveries.
Well, there's no doubt that there are question marks about Q4 and the holiday season for almost every company. Amazon is typically conservative with guidance, especially in Q4. So I think that's explainable. And I think I would agree with what Mark described. The report, the headline top line number obscures an otherwise very strong report. And if you look at Amazon on a volume basis, growth remains well above 20%. So I think that should give investors some sense of relief, even though the stock is reacting this way today.
Mark, given what we're seeing, though, in this sell-off action on Alphabet, down more than 4%, Amazon down about 9%, even Facebook, which didn't report, down nearly 4% this morning at around $145 a share. Do investors need to adjust their price target expectations? Are we at the point where these guys need to be perfect, not just on the bottom line, but also on the top line to get to higher levels that some people might have been expecting?
Yeah, they're near term, probably very much a necessary valuation correction. Some of these stocks got well above their average forward multiples. It required kind of a fundamental re-rating in the business in terms of the business model, acceleration, revenue growth, and expansion and margin. You've had that with two names in the space, Netflix and Amazon. And I look at these names, I think there's some indiscriminate selling, but I also think there's some discriminate selling. And again, when companies miss numbers, they should trade off, and they normally do. But I think as you work through this, there's a couple of names that really look interesting here. You give me Netflix at 300, and I give you a stock I think can double in the next 3 years. It's trading off on these exposés about the company's culture that I don't think they're that unusual. I don't think it has any impact on fundamentals. It trades off on these fears about an Apple offering. I mean, there's been plenty of other offerings on Netflix. I think Netflix has won that game, so I'm a heavy buyer of Netflix at 300. I think that's a back up the truck price. And Facebook at 145 is trading at around 14 times earnings if you adjust for cash. You buy that. The trends that we hear on advertising from these names say that advertising growth rates are very consistent. That's the Snap read, that's the Twitter read, and that's the Google read. So if that's the case with Facebook, this stock is not pricing consistent revenue growth. It's pricing a real material deceleration. I don't think you're going to see it. You buy Facebook, and you can buy it here.
Yeah, the Facebook's the one I wanted to ask you about, Mark, because Reuters has a headline that they've discovered some more Iranian disinformation. They're going to disclose details shortly. We know what's happened with Snap. I mean, at what point do advertisers say, you know what, enough?
Well, I think if there were real problems with the tracking of campaigns, if there were challenges with ROI, yeah. I mean, advertisers at the end of the day are trying to get a return on those ad dollars. I don't think the ROIs have changed from an advertiser perspective for Google and for Facebook. Those are probably always going to be the two major must-buys in internet advertising. And I don't see anything in our survey work that changes that. Those are remain the two ROI kings. There are PR issues, platform security issues that Facebook needs to amp up spending in order to address, and I think they are doing that. So I think the stock's been de-risked both fundamentally and multiple-wise. That's what makes it an interesting entry point right here, right now.